Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So Matt, we just released an episode with all the answers we've ever gotten to our standard closing question on excess returns. And the standard closing question is, if you could teach one lesson to the average investor, what would it be? And we have now, as I learned when I put this together, we've accumulated 119 answers to this question, including answers, by the way, by me, you, and Justin, that I tacked onto the end. So we've gotten a lot of insights, but I thought it would be really good to put this together into maybe some of the ones that we think are the most relevant for the average investor, because a lot of people are not going to watch and go through our 3-hour episode with 119 answers in it. So we wanted to pull together, I think we have 10 or 12 here, of the ones we think are the most relevant for people and we think are maybe the biggest lessons that your average investor should learn.
It's important to see these things from people in different walks of life. This is kind of getting handed some wisdom from people where it's not just a tactic. It's not even just like a strategy. It's at a higher level of how do some really thoughtful, articulate, smart people kind of set vision on this whole thing when they look out on it, and the what, the why of their doing it, the what, the why of like what they try to pass on to other people who are like, hey, if just learn something from me, maybe remember this. I love the longer form version of this. I love that you can just hear these last answers, but I think these 10 or 12 or however many we got here, they're just super useful. They're life philosophy as much as their investment portfolio philosophy.
And it's cool because people went in all kinds of different directions with this. For anyone who's watched the whole thing, you'll see it. People went all kinds of different ways. And I think that's sort of the nature of the question. The question is meant to be a question that can go in all kinds of different directions. And this is one of the questions that we do tell every guest in advance that we're going to ask it, because I think it's one of those things that off the top of your head, like what's the one lesson I would teach the average investor? It's even for people who are very practiced, they'll come up with an answer, but it won't be their best answer.
It's a great
gotcha
question. It's a great gotcha question. Let's surprise people with.
You're going to get a better answer if somebody thinks about like, what's the one lesson I would teach the average investor than if you just like throw it on the spot on them. So I think we got a lot better answers here because we did allow people to prepare their answers beforehand.
Once in a while, it's good to say before you impart one piece of life advice and wisdom. It's not a
give it a little bit of thought.
A little bit of thought.
Yeah.
What's the last joke you heard?
Everybody loves like the person that can go on CNBC and off the top of their head can answer every question well. But I mean, pretty much everyone, even the great people, when they get a little time to think about what they're gonna say, often give better answers to a lot of things. So anyway, we should probably roll into them here. And we've got. I think that this is a great one to start on. And this is the one, like whenever I share it on Twitter and stuff, this is always the one that gets the most likes and the most retweets and everything. And this is from Michael Mauboussin. And this is about the idea of base rates.
I think that I would encourage people to learn about and apply base rates as they think about the world of investing. By the way, it's not just valuable for investing, but really business or your life. Actually, it's good for your life. And again, a base rate, the basic setup is the natural way to think about the world or solve your problems is to gather a bunch of information and combine it with your own inputs and experience and project into the future. And that's what we all do, left to our own devices. Using base rate says, I'm going to think about what I'm facing now or my problem as an instance of a larger reference class. I'm going to basically ask what happened when other people or organizations were in this position before. And it's a very unnatural way to think because you have to leave aside, sort of your own information gathering and your own experience. We all tend to place a lot of value on that. And you have to find and appeal to the base rate, which may not be at your fingertips, and often it's not. So you have to go out and make a little effort to find it. But once you do, I think it reshapes how you think a lot about the world. And I think makes you more grounded in terms of how you think about how things are likely to unfold. So to me, if that would be the one idea, is to say, let's think about base rates. You mentioned before jokingly that we're in that sort of season where people do forecasts. That's a great example where base rates would be very helpful. And you sort of made the joke 10% with some standard deviation, but that's actually the right way to think about it. That's actually the right answer. And that's informed by base rates. So you got to the right place and the right way to think about it using that actual technique. So to me, that would be the one bit of advice I would give. And if I could go back to my 20-year-old self, that's certainly what I would teach. And by the way, I would just say that it's remarkable how underutilized this concept is notwithstanding its demonstrable power, right? So anyway, that would be my concluding thought.
Yeah, so this is really cool to me because I think all of us think we can predict things. Like, I think I can predict things. You know, one of the reasons we do our annual prediction episode of the podcast is to prove to me that I cannot predict things, because the stuff I said is going to end up being a bunch of garbage and be completely wrong. But like, what we want to do is we want to take the information we have, we want to process that information, we want to put it together, and we want to say, I think this is going to happen in the economy, or I think this is going to happen in the market. And what Michael's saying is maybe take a step back and just say, what happened in the past? When these conditions were true, when this was going on, like, let's look at the reference class of everything that happened in the past. And let's say, what can we learn from that versus me trying to take what is called the inside view in terms of like taking my own analysis and trying to figure it out. Maybe a good thing to do is use the outside view and just say what's happened in the past when these types of things have happened.
Asking how this compares. And this is one of those lessons you just see. I'm pretty sure I first learned this from reading Mauboussin stuff, from listening to him on podcasts, years and years ago. The inside outside view, which you referenced, his whole Kentucky Derby. I don't think he said it in this interview. I can't remember if it's in the rest of the interview, where he gives the example of like, you can't just think about how fast the horse is. You got to think about how fast is this horse compared to the other horses, like on this type of terrain with this type of weather, with all these different variables going in. It's a really useful way to think about any singular investment as a reference in as an instance of a larger reference class. Did I get that right? The concept that we then see applied with people like Aswath Damodaran and some of the other people, where like, I don't think I could have understood the way Professor Damodaran would approach the valuing of Uber pre-IPO and just how to think through it. Going, okay, well, we've never had a company like this before. So how do we actually think about what it could be worth? And how he walks through the steps of going like, okay, here's what other very successful high growth companies looked like 3 years, 5 years, 10 years, whatever it was after the fact. Then here's how we back into those numbers and those valuations along the way. It's seeing these things as base rates and making you look for, if I think this is the story, how do I fit it in both qualitatively and quantitatively into other stories and other situations where we actually have some examples to draw from. Endlessly informative concept, base rates.
I think what he talked about with predicting like what the stock market could do in any given year was an interesting use of this. And he admitted this isn't an exact science, but the idea is what most people do is they take all what's going on in the economy, the valuations, they take everything and they're like, the S&P will be 5720 at the end of the year, like your average forecaster. Well, maybe if we use a base rate approach, what we probably would do is say, on average, the stock market does about 10%. Let's say the standard deviation is 15. So probably -5 to 25. I've probably got a 68% chance, assuming returns are normally distributed, which they're not, but it's just to use it as a normal example. Like, but if I go out there with my market forecast, we're probably going to see somewhere between -5 and 25% this year with a 68% chance. Nobody's going to listen to my market forecast, but that actually is a more accurate way to look at it than saying the S&P is going to end the year at 5720.
I used to work with a guy who used to track all the street, and I don't know why he did this. He wasn't like a research guy. He just tracked all like the street forecasts for the S&P 500 for the year-end targets, and he'd update them throughout the year and then email us all the spreadsheet. And I was always amazed because I was just like, you could just take the starting point and basically add the average annual total return, adjust it modestly for your standard deviation or variance. Like, these are entirely predictable number sets and utterly meaningless in every sense of the word for what's going to happen. But this guy would religiously update it. I was like, is statistics a magic trick to you? Like, what's going on here?
Yeah, it's everybody wants to do it, and we're not in season, we're not in forecasting season right now, but we'll be coming up soon. And when we look back at last year's, they'll all be wrong, and this year's will all be wrong as well. And it's just a good way. Base rates is a good way to test when you're seeing people use the inside view, and you see people making forecasts. Using base rates, even if you're not making your own forecast, is maybe a good way to test that. And so, like what I just said about market returns, if somebody was trying to give you a very accurate prediction in the stock market, would lead you to conclude, wait a second, this is a really, really wide range, I can say with any kind of confidence. Like this is just useless, this market prediction I'm getting.
An important reminder to just look at the math and think about the instance as part of a broader reference class. And when in doubt, do what I did and take your annual stock projection from Eddie Van Halen's AMP at 5150.
Probably just as much of a chance of being right.
Just as much of a chance.
I like this next one because it carries to any type of investor. And so this is from Rick Ferri, and he's talking about the benefits of keeping things simple.
Simpler the better. Honestly, if you can do it with two funds, do it with two funds. I mean, you don't need any more than a balanced index fund and a tax-deferred portfolio. And then in your taxable portfolio, if you're going to have stock in there, total stock market, total international, and something for a reserve fund of some sort. But I mean, the absolute simpler you make it, the better it is for you, the better it is for your family, the cheaper it is, the less taxing it is, and the more time you have to spend doing the things that you enjoy doing, which is not this. I hate to say it, but this is a necessity. I don't know if I could have been an airline pilot, but I decided to do this instead. I'm glad I did it. It was a real good exercise, but at some point in my life, I'm going to not want to have to think about any of this anymore. I don't know when that is. Like I said, I'm in my 70s. I want to rewrite some books and all of that. Maybe it'd be in my 80s. I don't know. But there's got to be more enjoyable things to do than this.
So the reason I love this is because this can apply to somebody who knows absolutely nothing about investing. Because if you know absolutely nothing about investing, what he's talking about is you probably could accomplish, what you want for your long-term goals with a couple funds. You don't need all this craziness. People tend to just keep adding stuff to the portfolio. We've talked about the mutual fund salad some advisors have. Like a basic approach to what you're trying to accomplish can work really well. But it also carries to somebody like me who's building factor strategies. You think those are complex, but the reality is most of the time when you try to make them complex, it can be done with a simpler approach. And I think back to like when Wes Gray was on the podcast recently, and he talked about like they used to have this crazy filter to try to like filter out bad companies from their value screen. And like when you read the book, it's like 10 pages of different filters with all kinds of symbols and everything. And like I programmed it at one point, and it was like so hard to do. There was so much going on, but they changed it. They realized, wait a second, with this simple approach, we can get 95% of the same way there, and there's just no reason to have all this stuff. So to me, it applies in all levels of investing. This idea of it doesn't mean you have to make it simple just for the simple's sake, but most of the time you can accomplish the same thing with a simpler approach than what you're doing.
The cutting through of the noise to get to the essence of the thing and tacking back on that. And sometimes you need to be hyper specific. Like you need a really, really deliberate surgery, scalpel, narrowed in idea of exactly what's going to happen. Other times you just need to be generally in that direction of correct. And I love the example of Wes doing this. And I also love the example, like with Rick Ferri, just saying for most of the things, for most of the time, unless you, and I think he would more or less agree with this too, but for a lot of people, I know this isn't a lot of the other answers, unless you really are passionate about doing the work, about doing the math, about thinking about these things, you shouldn't torture yourself, and you definitely shouldn't way overpay for advice that's not necessarily improving the outcome by a massive, massive percent. You can get most of the way there in many cases just by figuring out what's the simple, most logical way to do this. And, if not, and we made him the playlist, right? Do you think Rick Ferri liked the KISS playlist?
I think he did. He like it on Twitter? I thought he did.
He did like it on Twitter. I still haven't seen him put on like the.
I mean, I don't know if he listens to it at home or anything, but he at least liked it on Twitter.
He strikes me as a guy who'd be walking around the house bumping Beth. What do you think?
It could be. He's playing Matt Ziegler's playlist all day.
On repeat, 10 KISS songs that aren't even.
But the other cool thing with this is like a lot of times simple is also cheap in investing, which is good too.
Yeah.
Because obviously reducing fees is really important. And what Rick was talking about, like a lot of these approaches to getting broad market exposure are also have the advantage of being not only simple, but also very cheap.
Yeah. Especially when you're saving. The idea of keeping costs down is something you can control versus market returns, which you can't control. And there's always going to be a balancing act. If you need advice, guidance, and other things, you just have to know what you're paying for. I think when people kind of get like snookered into paying up for asset management or other things when it's not additive either to what they're doing or what they actually need in their life on the planning, the tax planning, the legal, all the other sides that can get wrapped into this stuff. Yeah, expenses are something you can control. You should always be aware and cost conscious when it comes to those things, not to spite yourself, but to be aware of why you're making the decisions you're making. Keep it simple is one of the great guiding principles for that.
This next one's really interesting to me because diversification is something you'll get universal agreement upon. Pretty much anybody you talk to, and anybody we asked this question to would have agreed diversification is good. But like what diversification is something you will get disagreement on, especially now. And so I think this is really interesting. This is Bob Elliott talking about how he defines diversification and why that's his most important advice.
Diversification. It's that simple. Diversification, right, is the ticket to building durable wealth over time. And when I emphasize that diversification, I don't mean stocks and bonds are not diversification. It's better than holding an all stock portfolio. It's better than holding one stock. But true diversification means diversifying your asset class exposures and diversifying your strategy exposure, your alpha strategy exposures, right, in order to generate that consistent return. And that I think a lot of people have really over the last 40 years have become immune to what diversification, or desensitized to what diversification really means, because they've only seen assets work in one way. But talk to people who invested in the 70s and the 60s and talk to them about how they survived those dynamics without, facing huge, painful drawdowns particularly in real terms, in their wealth. And the way that they did that was by holding a lot of different assets, gold, commodities, inflation index bonds. I mean, they didn't exist then, but the effective exposure of inflation index bonds, real assets in various kinds. That's how they survived that period, during a period when stocks and bonds didn't do well. And that's what you have to face. What does a high interest rate environment look like with elevated inflation? It's something you've never seen before. And so open your mind to the diversification possibilities that are out there.
So this was interesting to me because, like, coming up in investing, like, I was certainly taught about the benefits of diversification, but I feel like for many, many years, we were taught the way you diversify is you just have bonds. You have stocks and you add bonds to the stocks and then you're diversified. But we went through this 40-year period where that worked all the time, and all of our views are sort of, affected by the fact that worked all the time. And now we have to take a step back. I don't know if we're going to continue to get inflation or not. But if you think about this from a long-term perspective, if you're not worried about whether we have inflation now or we don't have inflation now, I think Bob's right that true diversification is not just stocks and bonds. If you think about the different economic outcomes you can get, stocks and bonds have a major hole, as we saw in 2022, in terms of one outcome where they don't do a very good job.
I think you need, and I think this is part of the broader interview, and anytime you get to hear Bob Elliott talk about stuff like this, you need redundancies. Like, you need 2 eyes and 2 lungs and 2 ears and all those simple redundancies. And then you need diversification. Like, you need the eyes and you need the ears. You don't just want one or the other. You want things that are not just going to like zig and zag, but things that can work in different environments and make sure you can survive to fight another day. I love in that comment when he invokes the 60s, the 70s, some of the other periods of time that we're just not thinking of it. They've become a smaller part, even in our long-term historical studies right now, where stuff just got weird and wonky and wild for a little period of time. You can't just assume that the thing that works over the broadest period is going to work over those smaller periods, especially if some of your life turning points happen in those periods. I think all the time about the differential that it makes, what the person, I remember working with a client whose parents had retired basically in the early 80s at like peak yields and more or less owned 0 stocks. But they had a ton of savings. It was all in like tax-free municipal bonds in the state they lived in. And it was like a grand slam. It was, millions and millions of dollars stacked up, paying crazy interest rates, many of which that were locked in for like 20, 30. And I think there was even some like 50-year periods that were locked in at these insane rates. And they were totally tax-free. And it was like, well, mom and dad always did this. They only ever bought municipal bonds. It's like, well, it's a little bit different when those things pay 10 or 12 or 15%. And you got you're tax-free at every level, and you can lock in at these rates, and inflation drops for that whole period of time. You got to be able to think of these broader things. I mean, for me personally, it's like, you got Matt Ziegler, you might want Ziggy, the comic strip character, you might want Zig Ziglar for your life advice. You start mashing all these Ziglers together, all these Zigs, and you start getting some really interesting stuff to zag against.
Yeah, it was interesting. I just put up a podcast today with Jason Buck, an interview I did with him. And we talked about this a lot because he's a big believer in the same exact thing. And one of the things we did in that podcast is we looked at the longest returns we could possibly find for stocks and for bonds and for other stuff too. And when you look at that, like it may not be, we were sort of challenging, or he was challenging the idea of stocks for the long run, which I like doing because I'm a big believer in that idea and I want to challenge myself. But, you think about it, if you look over the long term, I mean, stocks have produced, like US stocks have probably produced, I think about 6 to 7% real over inflation. Global stocks have produced maybe 5, I think he said. So the US has had a pretty good premium there. Bonds have produced something obviously significantly less than that. The commodity trend has produced something a little bit less than that. But the idea is when you look across all the different countries and all the different experiences, the US experience is very, very different than the other countries. And so when you assume I'm going to get the same thing that I've gotten, even over a period of 100 years, if you assume I'm going to get that going forward, it might not make as strong of a case for diversification. But the reality is, and we'll talk about this when we talk about Adam Butler's one coming up, is the future may be very different than the past. And if we look at the other countries and we look at their experiences and put that all together, we may say, all right, the US, what we've seen in the US might be a little bit different than what we've seen in the past. And we might not get that 6.5%, 7% real. And if you get something lower than that, these other diversifying assets, not only are diversifying assets, but start to have more reasonable returns relative to stocks. So I just think it's an interesting thing to think about. And I think I'm a big believer in this idea. And this is the way we manage money. I mean, we have our diversified portfolios don't just have stocks and bonds. They have other things in there besides that.
We are huge proponents of whether it's alternatives or just thinking in other places to get those exposures that don't just act like stocks and bonds all the time. And the whole I don't know, the sheer lottery effect of it all, that here we are born into this country. There's so many things where it's just like, you've already won a bunch of these bets. You gotta, I think, recognize some of that as just lucky. Has the U.S. been a little bit extra lucky? There's definitely skill involved. Don't get me wrong. There's lots of things that I think set this up for success. But to just assume blindly without any question that it just goes on this way forever, hedge some of those bets. If you've made some money, just hedge some of the bets. Build it into your plan. Make that okay, because it's worth making it okay. Or at least I'm a believer.
So I don't want to rain on your parade here because I know you've got some very effective trading strategies, but this next lesson is from Andy Constan, and he's talking about how you may not actually have an edge.
The answer is find a portfolio you can live with, manage it passively through time, and don't think you have an edge because you probably don't.
So yeah, I think both of us probably have had times in our careers where we might think, oh, I've got an edge in this thing, but it's like there's so many people. Like I always think about how many smart people are out there competing and investing, how many powerful computers are processing all the data. And, anytime I think I have an edge, and anytime I listen to someone like Andy Constan, who has worked at basically every big name firm that exists in Wall Street, admitting he probably doesn't have an edge, I probably have to say I might not have one either.
I want the meme from this clip of just Andy Constan with "you do not have an edge" on it. And there may or may not be a few occasional like YouTube commenters and other things that we could just, maybe instead of a like or reply, we could just drop that meme into those giant threads of whatever sham scam trading strategies try to promote themselves below these things.
Well, in our comments where we have like, Susan B. Johnson saved me or whatever, like in our YouTube comments and made me tons of money, we should probably tell Susan B. Johnson that she may not have an edge either.
You've been constant. Yeah. No, it's just like you said. Andy is a brilliant man, brilliant thinker with all the track record in his career to show where he's seen this stuff. You're not as smart as you think you are, but the perk of that is neither is anybody else. And if you can approach it with that humility, then you can start to say, well, what things are smart? If the market or the, crowds can be smarter than I can be in many cases, start to look for the places where the crowd is being smart and figure out ways to keep it simple and follow along. And likewise, if we're going to take a stance and try to think somebody's wrong or everybody else is wrong, think about how you're going to build that position, build that trade, build that thinking. But at the end of the day, it's just really, really hard to have a sustainable edge over time.
I also love these guys that were able to like get those kind of lessons across in 15 seconds. Like we've got a couple in there. We actually have 2 answers from Andy, which are both like that. But I mean, he basically got the essence of this across like really, really quickly, which is kind of cool.
It's almost like he's practiced this.
Yeah, it's probably true. These guys have had some experience doing it. Yeah. So this next one is also very interesting. And this is from an interview we did a while back with GMO's Ben Inker. And he's talking about this idea that, if you think you're going to get a return in the market, you want to think about who's on the other side of that return and why should they give you that return.
I wish it was a really simple thing. I think it's a simple idea, but it requires more work than I would love. But that is, whenever you're investing in something, make sure you understand why you should get paid for owning this asset, for performing this activity. Understand why it not only makes sense for you as the investor, but whoever is going to be funding that investment on the other side. Why it makes sense for them to be giving you the return you need. I would say there's a lot of errors people can make as investors, but one of the crucial ones that people make time and time again is forgetting about the fact that if you're going to sustainably get a return, it needs to make sense to give you that return in terms of the person on the other side. And where you can't answer that question well, you're not investing, you're speculating. So I would say, for the retail investors who are buying, 1 week call options on AMC, the reality is you're not investing. The person on the other side has no reason to want to give you a high return, right? The person on the other side, for one thing, is a market maker, and the market maker is the casino. The casino is only there to try to make money off of your activity. But the simple truth is, whenever you're buying a call option, you're not doing anything useful. You only get the upside. And if you only get the upside, the person on the other side only gets the downside. There's no reason for them to want to give you a good return in the long run. So I think investors could avoid a lot of errors if they thought not just about, does this make sense for me? But does this make sense for me and the guy on the other side? If it doesn't make sense for the guy on the other side, this is not going to be a sustainable strategy in the long run.
So yeah, the example he used is a really good one, which is, and we've kind of gotten past the whole GameStop thing. I mean, I don't think there's as many people thinking they're going to be successful options traders as there were in the past, but that's a great example in terms of the idea here, which is that if I'm an options trader and I think I've got something that's going to work over the long term, who's going to give me that return? Well, Ken Griffin's going to give me that return. Well, let me look at my house right now. Let me look at Ken's, let me look at my bank account. I mean, this may shock you, Matt, but I'm not currently a billionaire. So let me look at what's going on with me and let's look at what's going on with Ken. It appears that most people who thought they had an edge over Ken ended up losing, from what I could tell.
Jack 4 comma hand. Come on. Like where's the bankroll here? I was asking you about this before we press record on this. And if anybody listening to this knows what I'm talking about, there was a paper, might've been a PhD dissertation or something else. I remember this from years ago. And it was basically who's on each side of not every trade, but it tracks some stuff. I want to say like stocks or other things over a market cycle. I think it might've been indexes. It could have been individual security or an individual security. And it basically said like, here's when passive is going in and likely buying or likely selling. Here's when value is buying, but momentum is selling. Here's when value is selling, but momentum is likely buying. And it kind of showed maybe 10 or 20 or 30 or 40 of these factors or these basically like quantitative ways we can think about approaches to markets and who you would think would be doing these different behaviors over the course of time. There's no buyer without a seller. There's no seller without a buyer. So you got to think about what is the logical reason or illogical reasons that somebody's in that spot in that given moment. It's a wonderfully useful exercise anytime you're buying and selling something. And if nothing else, this is one of those great examples where it's step away from thinking of it in the broader markets for a second. Think about your house or something like that. If you want to sell your house, you got to ask the question of who wants to move into this neighborhood? Why do they want to move into this neighborhood? What access to financing do they have? Those all are going to populate the flow of potential buyers to look at this property. And what better lesson than just say, like, if you're going to get a return, you got to understand the motivations of that person on the other side of the trade.
And I like how these lessons, they build on each other. They work together. So let's go back to Andy Constan. He says, you don't have an edge. You can say, no, Andy, you're wrong. I've got an edge. All right, let's move on to Ben Inker. Who's on the other side of your trade and why are they giving you a return? Can you get through that step? And we'll be able to do this as we go through the whole podcast, but it's a good way to think about it. Like, that's fair enough. If you think Andy's wrong and you think you got an edge, well, then you should be able to explain this. You should be able to explain who's on the other side of your trade and you should be able to explain why they're giving you a return.
Yeah, an edge doesn't have to mean you're making a bajillion dollars off this thing. Edge could literally mean a couple of pennies or a fraction of a penny or just a couple of bucks. It could be the difference of just understanding. I'm going to, and again, use the real estate example. Somebody's going to sell their house. They're going to sell it for a gain. The question is, how much of a gain are they going to sell it for? That's going to be based on market dynamics and who's showing up. And unless you're in one of those crazy things where you list the house and then you get 100,000 above ask on the next day, as we saw in the last couple of years more than once, it might be a case where you go like, well, how much of this profit or how much additional am I willing to say like, okay, that's good enough. That's a version of an edge. That's a version of knowing who the other side is. There's layers to these things. They stack, to your point. And I think that's the best way to take these in, is they actually help you flesh out your own philosophy, because you can stack them up and think about what you agree with, what you disagree with, why. And they just force you to think harder about this stuff. It's so useful.
And to your point, these small edges can be the best ones to have. Like these small edges that you can just repeat and repeat over and over again. I mean, think again, go back to Ken Griffin. I mean, that's basically what they've got. They make a little bit of money over and over and over again. So from a statistical standpoint, that's the kind of edge you want. You've got a huge sample set of stuff. You know you're going to make money. Like it works out really well, versus being, I'm the guy who's the stock picker where I'm going to pick 2 or 3 stocks, right? Like that's an edge that's much harder to say, like, do I really have an edge?
I love the idea. And I love it's the small and repeatable, which is notoriously hard to do. And I'm thinking there's a great David Sedaris short story where he just talks about how he has a brief moment where I think he moved to Chicago and he's like, maybe I could survive on just things people just leave behind. He's like, oh, I found a cigarette on the street that's still perfectly good. Oh, I found $1 over here. I can go buy a cup of coffee. Oh, I found a quarter over here in this phone booth. Small edges, if they're repeatable, are super, super valuable and also therefore super rare. He did have to get a job in that short story.
So building on these, so we've decided we do have an edge. Andy Constan is wrong. We've decided Ben Eker, we figured out who's on the other side. Well, now we have to think about, all right, we think we can pick stocks, but maybe picking the stocks is not the most important thing here. Maybe what we do in terms of how we size those positions, maybe how we manage risk, maybe that's more important. And that's what Ehren Stanhope's getting at right here.
So, if I think back to my experience, I started investing in high school. My golf coach actually got me into investing because we would like ride to these golf matches, and this was in the late 90s. So he was on the phone with his broker selling call options on Cisco, which ended up not working out in the end. So that was a good learning experience in and of itself. But it took me a long time to figure out is that everybody spends time on what we refer to as security selection, what to buy, which stock to buy. And the sort of gap between, I think, most average investors and most pros is it's really twofold. So that the two other aspects of investing that there are very few, I should say, one of them, there are very few books about. The other one, there are lots of books about, but they're very sophisticated and they're geared towards institutional investors. So the second aspect that I think average investors need to understand and learn is portfolio construction. So you got to figure out how to size positions appropriately, because I think what a lot of people sort of do, and what I've seen is people will get super excited about an investment. They'll do a ton of work on it. But it's, one addition to their existing portfolio of like 10 other names. But because they're so excited about it, they always size it the highest, and they usually oversize it. They never want to sell it if if it goes into a loss position. So there are all these psychological issues. So learning how to size positions and manage them, I think is unbelievably important, but there's so little information that exists about how to do that. You really have to dig. And then the third component, so security selection, portfolio construction, and the third one is risk management, which again, there are tons of books on it, but they're not really approachable. It's really all about how to sort of bank your winners and cut your losers really, really quickly. There's actually one book that actually just came to mind. The Zurich Axioms is a really great one that speaks to sort of risk management, not sort of explicitly, but that's effectively what the rules are. And it's kind of like, from a golf perspective, security selection is like that guy that always goes to the driving range and he's always just hitting his driver. Portfolio construction is like the guy that's around like the chipping green, constantly working on his short game. And risk management is like the pro that's on the putting green, just banging out 8 and 10 footers, 100 of them before going on the course, and I think that a lot of people kind of miss the second two elements. So it's kind of like studying yourself, keep a trade journal or an investment journal or whatever your preferred style is to invest, and sort of measure your win rate, your average wins and losses, things like that, to kind of, view yourself in the mirror. I think all of those things will make a lot of people much better investors. I mean, we do it. We do it as a team. We do it all the time. We do it on our strategies, our factors, our themes, everything.
So Ehren is one of the most thoughtful people we've ever had on the podcast. Like, we have to have him back. I mean, we've had him a couple of times now, because every time he comes on, he has stuff like this. And this is against everything most people believe, which is everybody believes I got to pick the stocks. I'm a stock picker. Like, I got to get that right. If I get that right, I'm in great shape. And obviously, if you get every one of them right, you are in pretty good shape. But the reality is, when you think about it long term, thinking about how do I construct a portfolio around what I'm doing, whether it's just individual stocks or whether it's multi-assets, like, how do I size these positions? How do I have a risk management system in place? That usually ends up being much more important than the assets I'm picking.
Shout out to his golf coach, right? Like, getting these lessons from an early age is really amazing.
What was he selling? I think he was selling call options in Cisco or something. Is that what he said?
Yeah, over the phone or whatever while they were driving along.
It's a dangerous game to play.
I love it so much. I love being a kid and like just being like, what is even happening with this adult in my life? But it's stuck around just long enough that he can process it all these years later as the brilliant man in mind that he is today. This idea too of just position sizing and risk management, I think it's so critical to like just planners and allocators. And I think it's one of those things, the first time you really engage it, you almost have to engage with it at the extremes. You have to think about, what does like extreme concentration look like in a position, and why was that the wrong move to make? What does it mean to be like extremely out of something, and why was that the wrong thing to make? You could make like two examples would be, the guy, he saves up his money and he takes it and he puts it all in the coffee can, instead of like even putting it in a savings account where it earns any interest. And 30 or 40 or 50 years later, it's just like, well, I've got more or less worthless paper because it inflated it all away, and I should have just put it in a savings account before I rip Van Winkle. That might be a preview to a later conversation we're about to have. But then there's the other side too. You could have, and I've met some of these people, you start a business, the business is going well, you forego savings to plow more and more money into the business, but you never step back and think about it as an instance of a broader reference class to understand that I'm taking an insane amount of risk. I've sized this position all wrong, especially when there's debt or leverage or anything else involved. And when that business gets wiped out, it ends up completely wiping out the family, the individual, whatever it is. This is position sizing and risk management writ large. And it matters as much in our portfolio, how we build stuff and what those building blocks stack up like, as it does in our financial plans and our broader asset allocations across all of our assets. I mean, how many times do we hear the stories, every like weird deleveraging cycle or crisis that we go through? And it's, you hear about, I'm thinking about Big Short stuff where it's like somebody owns 3 pieces of property and has some money in the market, but they're levered up so much that just the first domino goes and you clear out the rest for fire sale discounts. That's the kind of stuff. If you know this, if you ask these questions, what Ehren Stanhope's trying to tell you to do, you have a better chance of at least avoiding these disastrous outcomes.
Yeah, and to your point, this happens to sophisticated investors all the time. They've got their position sizing wrong. They've got their risk management wrong. Like I think about Melvin Capital with GameStop. You think about long-term capital management. These were very, very sophisticated people who had systems in place to handle this stuff, position sizing, risk management, et cetera, but it still blew up on them. And it just shows how incredibly important it is. And it can be a difficult thing to get right.
Goes back to what we were talking about earlier. It's just getting that redundancy and diversification in place so that you have to be thinking and talking about this stuff. And if you're all walled up in your formulas or your math or your spreadsheets on the thing and you're not, there's a lot of danger in just not communicating this stuff and just thinking, if everything I assume goes wrong, am I still going to survive?
So one of the things I've learned doing the separate podcast, Breaking News, that we do with Ben Hunt is the importance of words. And I think this next one with Jason Buck is a great example of this. We call our portfolio, but maybe if we called it something different, maybe we would treat it a little bit differently. So I'll let Jason explain.
It's tough for me. I hate giving advice because I don't listen to any myself, and I don't really think I have any. But I always like to watch what people do, not what they say. And that's why I was happy to be on here to talk about what we do, because that's how I view the world. The one piece of advice I'd give, or I would think about, is that stop thinking about your savings as investments. That's where I think the industry's lied to all of us, is everybody thinks I'm going to put this money away and I'm going to get rich off of it so then I can retire to a beach somewhere. These are your savings. You need there to be when they need them most and to outpace inflation. As soon as you start thinking about a way to get risk, you're going to take imprudent risks and you're likely going to lose most of them, or they can be underwater for decades. So the only way to get rich is in your business, your job, whatever you want to do, but your savings need to be as robust as possible so they'll be there when you need them most.
So I really love this idea, because I think about, like, if I'm going to go make a trade in my portfolio and I say, all right, I'm going to go buy, GameStop call options in my portfolio. I think about that one way. But now if I go, I'm going to go take my savings and I'm going to go buy GameStop call options, I'm going to think about that in a very, very different way. I'm like, wait a second, I don't want to risk my savings on that. I think that's great. I think if like everybody started referring to their portfolio as their savings, I think we might have better decisions that are made.
We'd probably have more conservative decisions. I think about this a lot when I think about double entry bookkeeping. I think about this a lot when this is part of the appeal or the draw to like the modern monetary theory people and stuff like that, where it's, you can't ever think about, like, if you're pushing one thing, you're always pulling another. There's always a thing. Like we talk about, like, investing in something is, outvesting in another thing. I don't know what's the opposite there. So it's like, if I'm going like into savings and then also into investing, it's making that question of like, okay, but if it's in savings, does savings confer some type of conservative nature to it because it's been saved and therefore I don't want it to be lost again? It forces us to grapple with this other philosophy on what it is. Now, it's okay to have money that you've extracted, like I went to work and now I have money in savings and now I have excess funds that came out of my work job and I want to go buy, I don't know, the GameStop call options, or pick anything from as degenerate as you want to going to buy just a regular index fund or something. But don't call that savings, maybe. I think that's part of the point. It's really easy to become unsaved, to become put at risk because you thought of these things the wrong way, because you told yourself the wrong word. And then back to that example we just had, you bought the 3 investment properties, you're all levered up to the gills and you're just like, oh, I got plenty of equity in this house and I have this big brokerage account that I've saved up all this money into, but then the leverage wipes you out. If you're not thinking of it as like true savings being truly conservative and protected, those stories can get the best of you real fast.
Yeah, to your point, I mean, you probably could take this too far too. Like if you think about, if you refer to your portfolio as savings and then suddenly you've got it in CDs or something, like that's probably not the greatest long-term decision because you obviously want to grow it. But I think the other part of this point is most people are going to build their wealth through something other than their portfolio. Most people are going to build it with their human capital over time. And if you think about, if I'm taking this risk in with my human capital, if you use the word savings for your portfolio, it might lead you to do something like what Jason's doing, something more of a total return type thing, something that's not as risky. It might lead you to think about, like, I really don't want to lose this money. Like, I'm taking my risk in my life. I'm taking my risk with what I'm doing in my career. I want to maybe at least think twice before I do something too risky with the other side of the portfolio. So I think that's a good way to maybe think about it as savings.
That's why all of my money is in Jack Forehand coins, which
those, if they exist, would be certainly worth us. I think we could safely say that.
But the point of it's coming out of your career, it's coming out of your job, it's coming out of the exchange of your human capital, where you say, I've given my time and effort for something, and I've been compensated for that time and effort because of whatever it is, whether you're a plumber or a portfolio manager, you've extracted some value from that. And then you say, okay, in exchange for my time and effort, I have this resource, this capital. Now, where do I want to reinvest that capital? Do I want it in my investment capital? Do I want it in some type of savings account or something else that just helps me support my family, helps me support my friends, my social network, my social fabric, whatever it is? And these are all real considerations to make if you just let other people push you around with those words. And this is part of what I admire so much about Jason is Jason doesn't let these things just be words. He's really thought with intention on how he wants to approach it to to make the best go at his future that he can make. I really admire that.
So if I had asked Justin one of these, I'm definitely going to put in, I think you both would have guessed the next one that's in here, because I've used this probably in at least 10 podcast episodes now. It's reaching the level of embarrassing. I've used this so many times, but I think it's a really cool lesson. And Adam said it so well. So here's Adam Butler talking about the past and the future and how we can think about that.
Yeah, I mean, it would be diversify, right? It would be humble about what you know and what you can know, and don't be over-reliant on what you observed in the past. The past is one sample draw from an infinite variety of potential sample draws that we might get in the future in terms of combinations of inflation, growth, geopolitical risk, supply-demand dynamics, technological shocks, et cetera. And the future is probably going to look quite a bit different from the past. And so the best way to prepare for the unknown is to diversify. So I think that would be my core message.
So yeah, I love this idea of one sample draw in an infinite series of sample draws, because the thing you think about, and this goes back to what we were talking about Jason Buck and what we talked about in the podcast that we released with him today, is you think 100 years, like I can draw a lot of conclusions for 100 years. Like I can pretty much think if I've got 100 years, like the next 100's pretty much going to play out the same way. And when you dig into the data, you realize like there are a lot of different ways those 100 years could have played out, even a period that long. Like even if you think about the idea that US stocks have produced 6 to 7% real, whereas international or global stocks have produced 5, like that's a big difference. And inside of there's if you look at the spread on the different countries, I think Australia is one of the best along with the US, like, and obviously then you've got the Russias of the world that just went to zero. Like there's a lot of different ways that these things have played out. So even over a period of 100 years, you could have had a completely different past than we've had. And if I'm going to use that past to predict the future, I've got to keep that in mind.
Uncertainty means more things can happen than will happen. So if it's the one spaghetti noodle that you pulled out of the pot, you got to realize before you throw it back in or you think about you playing that forward for the next thing, it's that the luck of that draw, that path that got drawn was just one of many, many things that could have happened. And this reminder that the past could have played out differently just as much as the future very likely will play out differently from what just occurred behind it. It's a profound reminder. There's no mistake you keep bringing this one back up because this is one of the most important lessons, I think, in life in general.
Yeah, we don't want to be doom and gloom with this. Like, I mean, I don't think the U.S. is going to see the path Russia saw. I mean, obviously, there's so many differences between the United States and Russia. I mean, I don't think that's something, at least for me personally, as someone investing in U.S. markets, I'm not worried about the path of Russia. But let's look at the path of Japan. I mean, could that have been our path? It could have been. And I mean, you had dead money invested in the Japanese market for decades. Now, we're not at the valuations Japan was at. Japan was at a cape of 100 when it started. We're nowhere near that. We're not even at our own .com yet. But it's just something to think about. Like the future could be very different than we think. And some of the things we take for granted when we look at the U.S. data may not be the way it plays out. And that doesn't mean stocks and bonds aren't going to be a great investment for the long term. It doesn't mean the U.S. isn't going to be a great investment for the long term. It just means we think about the other possibilities. And we look and say, as someone like you is building a financial plan, we think about, all right, this might play out a little bit differently than we think. Maybe we take that into account in what we're doing.
You know, the spaghetti noodle is still a spaghetti noodle. You might pick a different one, but you still have a spaghetti noodle. And most of the time when we're thinking about this stuff, and I think that's the optimist in me talking. That's where I don't think we go the Russia route. I hope we don't go the Japanese route, but you can certainly see where some of that stuff comes from. But it's like you're pulling out the single spaghetti noodle from the whole knot of potential spaghetti. You're probably not pulling out, a snake. You're not pulling out like something deadly. And that's an important reminder here too. If we're looking at capitalism, if we're looking at optimistically, if we're looking at there's some checks and balances in the system still, then the hope is there's a lot of good things that come from when businesses are just trying to keep staying in business for the long run, not just for a short-term decision or to make a quarterly earnings report. But when they're actually committed to keeping the lights on for the long run, that creates jobs, that creates consumption, that creates all sorts of good stuff. And I'm a believer that you may not be able to pick or project exactly which which noodle is coming out of the pot, but noodles in the pot are not a bad thing to be drawing from, even if yours is slightly more al dente than you'd preferred.
So I was a little jealous of the next one because I am incapable of taking a nap. I can sleep at night. I can't sleep at any other time. So this is Meb Faber talking about why investors should be Rip Van Winkle instead of Nostradamus.
There's a quote we've been using lately, despite all the amount of time we spend talking about the future and forecasting and things people should think about. I think the quote is, for most investors, it's better to be Rip Van Winkle than Nostradamus. Meaning, what does everyone on CNBC do all day? They like predicting what's going to happen with Google earnings or the price of wheat or what the Fed's going to do. And is gold a good part of your portfolio? Like all these things everyone stresses about. But in reality, like coming up with a portfolio, particularly with public markets, like I want that sucker to be on autopilot. I don't ever want to think about my public market investments ever. Like let that thing whir in the background, little robot Meb 2000, and just be done with it. And, also, like I see my cash account as like my investment account as a cash account, but it just kind of like hums in the background. And that's why some of these platforms like Betterment, I think are pretty great. Vanguard has one too. But essentially this concept of like, put it in there, invest as much as you can where you're happy and comfortable with it and let it just happen in the background and forget about it and spend zero time, particularly in public markets and macro. Going back to, by the way, it's startups. One of the biggest benefits of startups is investing is it's the most optimistic thing in the world. Like you spend all day like, oh my God, these amazing ideas, these life-changing technologies, these impassioned founders. And then you turn on CNBC, it's just like, they're just like bombarded with negativity and wars and pandemics, just like barf. Like it's so tough. So to me, spend less time on the like negativity and forecasting and future prediction business, which is impossible, and more on the like, hey, I'm going to save, put it over here. And it doesn't matter what you own. I mean, it does, but it matters more that you save and invest in the first place. This concept, this ownership mentality, I think is important. So be Rip Van Winkle. I like to sleep. I like to take naps.
So this gets back to what we've been talking about. Like everybody wants to be Nostradamus. Everybody wants to predict everything. But like as Meb talks about, like having a set it and forget it thing where you can go take a nap and you can move on with your life and you're not sitting like spending your days worrying about your public markets portfolio is probably a better way to go than making all these changes because I think I can predict the future.
It's a good take. I admire the Rip Van Winkle Nostradamus, comparison. I take modest issue in just how messed up Rip Van Winkle's life is.
I didn't even know that.
Do you remember any of that?
I don't even know. This could be a whole separate podcast.
Oh, yeah. I mean, his wife's dead. He has to like move in with his daughter. There's all this stuff of people talking about like the ghosts in the hills and the crazies. Like,
oh, wow.
It's not the best future that he wakes up in for lots of reasons. That's a whole other conversation. But the point stands. You want to basically be able to go take that nap. You want to be able to go relax. Again, like worry about other stuff. Don't just fall asleep and have your life decay and rot behind you. But, you want to be able to like go to sleep, let the things do their job and not be obsessive over picking what's going to happen next. And maybe you don't wake up in a horrible scenario. I don't know. Somewhere in like 3-body problem. It's just like the people who got put into like the temporary comas and wake up like decades and eons into the future. Like there's some other ways we could look at this. There's cryogenic freezing or something like that, maybe. That makes me feel a little bit better than Rip Van Winkle and the weird, despairing reality of some of his future.
And these all play together. I mean, this plays into Bob Elliott's idea of diversification. This plays into Ehren Stanhope's idea of risk management. I mean, those are the things that allow you to be that. Because if you're sitting there, with a bunch of, profitless tech companies and that's your whole portfolio, you're probably not taking too many naps because you're too worried about what's going on. So all of this ties together, I think, as we bring these together.
And I appreciate this too. I'm not once in a great blue moon I can take a nap, but I don't know if you fall to this too. I fall to if I do take a nap and I do succeed, the odds of me having like nap coma for the rest of the day.
Yeah.
Like it just, I'll be in a fog and it's, I might as well just go get drunk or something.
That seems like better. That's our lesson for the podcast. Go get drunk instead of taking a nap it's the best events we have.
Put it on the cover.
Right.
What do we got next?
Put it on the cover. That'll be my highest click-through rate ever, probably. So anyway, we're moving on to the next one. We've got a dual lesson here, and it's both guys from Ritholtz Wealth Management, Michael Batnick and Ben Carlson. And I think there's I put them together because I think they tie really together. One is people think there's this idea of there is this perfect portfolio out there. And I think both of their answers address that fact.
I think there probably is no perfect way to save and invest. There's no top 10 list you can read, or there's no book you can read that's going to like completely change your life and make it easier for you to figure it out. I think you just have to kind of pick a strategy and then stick with it come hell or high water. Because I think one of the hardest parts is these days we can always see how other people are saving and investing, and this person is investing in this. And I think it's probably never been a better time to be an individual investor in terms of the strategies and products and tools we have available. I mean, if you think about some of the strategies that are now offered in a tax-efficient ETF that were only available to rich individuals or institutions or hedge funds back in the day, and individuals can now use these same strategies for pennies on the dollar in terms of costs. That's a great thing. The problem is there's so many choices these days for what you can invest in that it makes it much harder for people to stick with a strategy. So I think for most people, the good strategy you can stick with is vastly superior to the great strategy that you can't stick with. It's just really hard for people to find that one strategy and stick with it. So I think that's kind of the lesson I'd impart on a lot of people is just, if you find a strategy that works for you, don't worry what everyone else is doing and just stick with your own strategy and call it a day.
I guess the first thing that comes to mind is there is no universal playbook for investing. If there was, everyone would be following the same thing. So there's no 1 or 10 right ways to invest. And there's probably a lot of wrong ways to invest. But there's also a lot of reasonable ways to invest. And the most important thing, in my opinion, is getting to the place where you're comfortable doing what works for you. Even if that's, something that would be subpar in a spreadsheet, 40% cash, 60% equities, whatever it is. Whatever you have to do to get to the place that you can stick to the strategy through thick and thin. And when I say stick to the strategy doesn't have to be buy and hold, but you have to have some sort of philosophy that governs you, right? And because if you don't have that, then you're just flopping like a fish out of water. So some people get there quicker than others. Some people never get there. But I think that would be the most important thing, is just to find whatever jives with your personality is the most important thing.
So I mean, what Ben was basically saying is there is no perfect portfolio. And what Michael was saying is whatever you can stick with is probably a better portfolio than trying to search for the perfect portfolio. And I think those tie together really well, because all of us get trapped in, this is the exact portfolio I should have. But really, and it plays into what Meb said too, like the portfolio that achieves your goals and allows you to take the naps. I mean, that's probably the right portfolio for you. And maybe someone like me can give you a spreadsheet and say, well, I've produced something with better returns than your portfolio, but it doesn't really matter. If it's right for you, if you believe in it, even if it's something that's maybe outside of the norm of what someone like me would say is a good portfolio, as long as it makes sense, you expect to have a reason it'll work over the long term, and you can live with it, that's probably a really good portfolio for you, regardless of what the spreadsheet says.
You need to have context for all these things. It's so funny to me that we talk about this. You can talk about this with kids in choosing a career or career strategy, but we talk about that like it's like, well, little Johnny could be an astronaut someday. He's got the chops for it, but little Jack can't be an astronaut. That's insane. Here's all the reasons that would be a terrible idea. Likewise, I don't want to be an astronaut. I don't want to be flung into space and go through all the training or do all the other things. It's not for me. It's not in the cards. So understanding why would that be any different from portfolios? I'm not supposed to be a surgeon. I get it. The hand is, it's just, the trigger finger, whatever. There's just all these things that I'm not wired to do. It's the same with portfolios. I'm also not wired to be some, crazy option, gamma scalping trader. I'm just not wired for it. Figure out the things that you're wired for, which are the things you can stick to across life. Portfolios actually should be one of the easier ones to do. Because to your point, pick the thing that you can put in place and basically go to sleep on, or get your enjoyment out of doing and be able to demonstrate why it's a productive thing for you to do. It's I'm not going to go moonlight as a surgeon or a sniper with my affirmation trigger fingers here, right? The steady hand says, Matt, stick to apparently making podcasts and doing financial planning.
Yeah. And as Michael said, if that means a little bit more cash than the models would say you should have, then that means a little bit more cash than the models say you should have. That's fine. I mean, that's not, we can't get trapped in this idea of thinking what the optimal thing is when we really have to just think about what's right for us. So moving to the next one, this one's really interesting to me because I think coming out of sort of 2020 and the GameStop era and what's been going on with faster moving markets and everything, I just feel like some people have lost this idea. We believe that we're trading like this piece of paper, this electronic thing, and we're buying and we're selling. And, GameStop is a great example of this because, people have traded GameStop, and then some people have made a lot of money on GameStop, and some people have lost a lot of money on GameStop. But I think when that whole saga happened, nobody really cared what was actually behind that. Nobody cared what the company did, what its prospects were, anything like that. So this is Chris Davis talking about the fact that stocks are companies.
Well, it would be that you own a business. You own a business. And this idea that you own a trading sardine instead of a business leads to so much bad behavior. And really, you guys raised it the best. When Jack was talking about selling those winners, if you just think that I own this wonderful portfolio of businesses and I want to pass them on to my kids or my grandkids, I think it keeps you out of owning stuff because you think it has a quick double, and it keeps you out of selling stuff simply because it doubled. And I think that everybody would do better, if they could think. I had my first girlfriend was from Maine, and her father worked at Bath Iron Works, and he showed me his portfolio. And it was such a wonderful portfolio. It was about 8 stocks that he had bought over the years, very thoughtfully and carefully. And it had just built into this real source of wealth. And I would guess that he had outperformed the market. But even if he had just simply tracked the market over this long period of time, but he did it with deep conviction because he saw each holding as a business. He didn't see it as a stock market. He didn't see it as a piece of paper. And I think that, really thinking about that and thinking about what it is to be an owner of a business, I think that would really improve a lot of people's returns over a long period of time.
So going back to this GameStop thing, that is effectively a company that would not exist if not for all the money they've raised, based on the Roaring Kitty stuff. So anybody who bothered to go behind the scenes and say, oh, what are the financials of this thing? How's it going? How is this idea of having these stores where they're selling these video games? How's that working out for them? How's their online strategy going? Anybody who asked those questions didn't get the greatest answers, but so many people were just trading what they were seeing. They were trading what they were seeing on their screen. And some people can be very successful at that, but it's important to separate speculating from investing. And I think if you're going to be an investor, you have to think about what Chris is talking about, which is you do own a portion, a share of an actual company that does things and should be hopefully generating cash doing those things at some point, at least, maybe if not now.
The word choice here, the narrative value of these things, just the same way we were talking a couple of minutes ago about thinking about saving and investing and what those words mean, and if you should be investing your savings, and does that mean the investments are coming out of savings and therefore you have to recategorize them in your mind. Stuff like this is, if we're talking about GameStop, if we're talking about public equity markets investing, we want to also be able to draw that corollary to, private equity investing. We want to think about, okay, if I'm going to go give money to a GameStop where I, as shareholder or whatever else, have zero control, zero influence, what's the business like? Is there a reason I think this is going up? And it's okay if I'm just playing the crowd, I'm playing the crowd. That can be a job. The job, therefore, is interpreting the crowd, not really the investment in the business or the company itself, but the underlying idea that, hey, at the end of the day, a business is there to make a profit. A business is there to raise money, at least, if nothing else, whether it's from customers or from other willing shareholders. These are the things that have to happen for a private company to stay in business. And for something to be public, we want to ask that question: what justifies this thing able to stay in business in this format, in this way? I'm not saying I have no clue what's going to happen with GameStop or whatever else over the days, weeks, years that come, but I am willing to say, if you can say every public investment I can also think of as a private investment, and every private investment I can see as a public investment, and maybe why it never deserves to be so, that's almost as close to an edge as I think I can get. And working with a lot of business owners, working with a lot of people who have assets or stakes in things that are different in nature for all sorts of reasons, whether that's real estate or something else altogether, you start to think about stuff like this and go, okay, not everything needs to scale to the moon, and that's okay.
And there's been debate, and we've had the debate in the podcast about whether fundamentals matter less and all that, but that's sort of beside this point. I mean, the point is whether fundamentals matter more or less, you're still buying a share of a company. Like if you're investing in something, you're still buying a share of that company. And I think that's important to keep in mind as people trade more and people make decisions like that. I just think it's important to keep in mind what it is I'm actually buying.
Yeah, fundamentals definitely I know we've covered this in other places. Fundamentals definitely matter less if there's a crowd of people who aren't concerned with the fundamentals
That's right.
at the table. Like it's a flow story. It's as our friend Dave Nada keeps saying, like flow rules everything around me. If a bunch of people show up to play a game and don't care anything for like the one guy at the table's understanding of the game, that fundamentals matter, Ben Graham forever. If that's one guy at the table, but there's 10 other people who think totally just like, hey, we're here to have a ball with this thing, fundamentals aren't going to matter. But flip that on its head or play that over time, or if those guys screw themselves up taking money for each other and there's only one rich guy left, the other guys have had to go home because they've blown themselves up. And now it's like guy with the money, but nobody else to trade with except for fundamental value guy again. Like fundamentals are going to matter again. Just the way it works. Depends who's sitting around that table with you. Back to know the people on the other side of your trade too.
So we spent the whole episode talking about investing, but I think this is a great way to end because some people went outside the world of investing in terms of the answers they gave us. And they really relate to keeping what we're doing, whether it's your career, whether it's your investing, keeping it in the context of what's important in your life.
Oh, just remember the portfolio is secondary to your life. Like that I honestly think we often really lose perspective around that. And I just continually emphasize, it's part of why you hear me railing against the behavior of the Federal Reserve, et cetera. We behave as if everything is about financial outcomes, as if the market tells us truth. There is no truth to be found in financial markets. There is no truth to be found in financial assets. There is no truth to be found in your relative success in terms of your wealth or anything else. The truth is to be found in the smile of your child, the greeting that your wife gives you when you come home, et cetera. Enjoy life and try to be a better person every single day in that context.
Put first things first, right? We spend all this time talking about money, but money is only as good as the life it builds and the people it serves. And so I think in your pursuit of money, right, in your pursuit of acquisition, make sure that none of it's happening at the expense of the people that you love the most. I think it just becomes really easy to let family and relationships take a back burner when you're trying to get ahead. It's easy to tell yourself that, you'll be around when, or you'll do this when. And, I just think that none of this should come at the expense of your health. None of this should come at the expense of your family. And I think that people who put first things first are going to be all right over time.
Yeah, so I love both of these. And this is what I want to wrap up on because all of us can get trapped in this. We can spend too much time thinking about this and we can spend too much time working. It's important to really take a step back and say, what are the most important things in my life? And for most people, that's their family. If they have kids, it's their kids. Like maybe I should just think about that and not get too wrapped up in everything that's going on in my portfolio. Maybe I shouldn't bring the bad day from work home or if I lost money in the market. I just think it's a great thing to I want to have these on my desktop and just be able to play these occasionally because I think they'd benefit me a lot if I thought about them more.
That's what the value of these clip shows is. And even just preparing for it. And I love that we're ending on this because, I do this other podcast, The Intentional Investor, and this is a big part of the conversation. It's literally, I have, this is like the cheat card. There's not outlines for those conversation. It literally boils down to this cheat card. And that's literally thought of as the five capitals and the things we care for. And my goal in those conversations is often to ignore financial capital as much as possible. Because I know these people have spent all their time thinking about that. And in many cases, they've gone on and been interviewed by other people talking about this. But the rest of life, what is the human capital? What is the intellectual property? What is the spiritual or the wisdom or the stuff that they're going to share with others? What is the social capital, the friends, the other people they keep around them? And if you're prioritizing those things as much as, if not more, than the financial capital, the crazy thing is a lot of times the financial capital, I'm not saying it takes care of itself. You gotta do stuff. You can't just be a bump on a log. But if you're investing in your friends, your relationships, if you're providing for your family, something's going on in that financial capital space too. And if you don't let the financial capital side of the equation take over everything else, this is where a lot of the actual meaning comes from. Because I know you felt deeply spiritually fulfilled when you made your billions of dollars on GameStop call options.
I did, yeah. It was fantastic.
But let me remind you about the children.
Exactly. So that was it. Yeah, these are fun to do. And I want people, like, if anybody likes these, if you find value in these, we're trying to do more of these clip shows. So if you find value, like them. I just talked last time about why these likes are irrelevant, but it's still, like, if you like this or you write a comment, we would appreciate it. And by the way, just as an aside, like, my son watches these videos all the time, and we were talking about this, how, like, likes and subscribes can be irrelevant. And, like, in the video, in these kids' videos, the guy will basically be like this video right now and I'll paint my wife's face red or something. Like, clearly he's filmed this well in advance. He has absolutely no idea if you like the video. But yet, I guess those techniques. So maybe you and I need to be, like, in the middle of the video, like this right now. We'll give you a bonus lesson or something like that. But maybe that'll get us more likes than what we usually do.
It's a great idea. My wife already appreciates that I'm not trying to paint her face red on live YouTube or something. So you've already dodged one bullet. I think diversification for the win.
And he did. He painted the face red. So even though he didn't know whether they actually liked it, he went ahead and just went over there with the paintbrush and, like, painted her face red. So.
No, the perverse incentives he just invented in that whole community. You're like, I didn't even have to like this guy. I control him with my mind.
So anyway, thank you everybody for joining us, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbono, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.